The markets are currently closed as it is Sunday, November 23rd, 2025. The last recorded closing price for Circle Internet Group, that's CRCL on the NYSE, was $72.44, reflecting a significant downturn of roughly 12.9% over the past week, with the stock sitting near its post-IPO lows. Most investors looking at that chart see a falling knife. They see Bitcoin correcting down to $85,000. They see the broader crypto winter narrative resurfacing in the headlines, and they assume Circle is just another casualty of the digital asset volatility casino. That is the expectation. Circle is a crypto stock, crypto is dumping, therefore Circle is a sell. Here is the reality. Circle is not a crypto gambling stock. It is a highly profitable, regulated neobank disguised as a technology company, currently trading at a valuation that fundamentally misunderstands its business model. While the market panics over the price of Bitcoin, Circle just posted Q3 net income of $214 million, up 202% year over year, effectively printing money from the interest rates on U.S. Treasury bills while you sleep. The disconnection between the stock price and the underlying cash flow machine is one of the most aggressive arbitrage opportunities we have seen in the fintech sector since the early days of Block or PayPal. Let's strip away the noise. The narrative driving this sell-off is that Circle is tethered to the price of assets like Bitcoin or Ethereum. This is a lazy correlation. Circle's primary product, USDC, is a stable coin. It does not fluctuate. Its business model is not based on the price of crypto, but on the velocity of money and the interest rates on the reserves backing that money. When you deposit $1,000 into Robinhood or Coinbase to buy USDC, Circle takes that $1,000, parks it in short-term U.S. Treasuries or cash equivalents, and keeps the yield. With interest rates still hovering in a profitable range, Circle is essentially operating with the mechanics of a high-margin bank, but without the overhead of physical branches or legacy mainframe systems. Consider the recent Q3 earnings report released just 10 days ago. Revenue hit $740 million, growing 66% year over year. More importantly, USDC in circulation grew 108% to $73.7 billion. While the market obsesses over NVIDIA stock and the AI hardware cycle, or wonders if Apple stock can squeeze more juice out of the iPhone, Circle is quietly building the economic OS for the internet. The volume of USDC transactions is exploding not because of speculation, but because of utility, cross-border payments, payroll, and settlement. The Genius Act, passed by the Senate earlier this year, cemented the regulatory moat around fully backed stablecoins, effectively handing Circle a government-sanctioned monopoly alongside a few competitors, while locking out unregulated offshore entities. Yet the stock is down. Why? Because the algorithmic trading bots on Interactive Brokers and the retail sentiment on SoFi Invest are still coupling Circle with the broader crypto basket. When Bitcoin sneezes, they sell Circle. This creates a massive inefficiency. You're getting a company with a P/E ratio of roughly 28x, remarkably low for a high-growth fintech that is growing its bottom line at triple-digit rates. If you're using Fidelity Wealth Management or looking at Fidelity mutual funds, you rarely see this kind of growth at a reasonable price in the current environmental situation. Most high-growth tech is trading at 50 or 60x earnings. Circle is being priced like a legacy regional bank while growing like a Silicon Valley unicorn. Let's look at the competitive landscape, which is where the expectation versus reality dynamic gets even sharper. The common belief is that Tether, USDT, is the king, and Circle is the runner-up. In terms of raw market cap, that has historically been true. But in terms of institutional trust, the tide has turned. Wall Street banks, Schwab Intelligent Portfolios, and major Fidelity brokerage accounts cannot legally or compliance-wise touch unregulated stablecoins. They need a vehicle that is audited, domiciled in the U.S., and transparent. That is USDC. As traditional finance, TradFi, continues to merge with decentralized finance, DeFi, the capital flows are strictly funneling into compliant rails. Circle is the only game in town for the Fortune 500. Furthermore, the partnership with Coinbase is a double-edged sword that the market is currently misinterpreting. Yes, Circle shares a portion of its reserve income with Coinbase, which acts as a distribution partner. Critics argue this dilutes Circle's margins. However, the reality is that Coinbase acts as the massive customer acquisition funnel that Circle doesn't have to pay for directly. Every user on the Coinbase platform or using the Coinbase wallet is a potential user of USDC. It's similar to how Apple uses its ecosystem to lock in service revenue. This distribution network is why USDC circulation doubled in a year where the broader crypto market was choppy. We also need to talk about the macro environment. The Federal Reserve's policy path in late 2025 has been a tug of war. If rates stay higher for longer, Circle's net interest margin remains fat. They earn 4 to 5% on $73 billion of other people's money. That is roughly $3 billion in annualized run rate revenue with near zero cost of goods sold. If rates are cut, it stimulates economic activity and borrowing, which drives up the volume of USDC in circulation. Circle wins in both scenarios. The bear case, that rates hit zero and crypto dies, is a scenario that looks increasingly unlikely given the sticky inflation data and the institutional adoption of blockchain tech. For the individual investor sitting at home using Robinhood stock trading or checking their SoFi active investing dashboard, the confusion is understandable. You see the red ticker, you read the headlines about Bitcoin crashing to $85,000, and you panic. But professional money managers using interactive brokers trading platforms are looking at the spread between Circle's earnings yield and the risk-free rate. They're seeing a company that has $1.35 billion in cash and short-term investments on its own balance sheet, separate from the reserves. This is a fortress balance sheet. I want you to pause for a second and think about your own portfolio. Comment below how many shares of Circle, CRCL, or even Bitcoin you currently hold, or if you are waiting for the price to drop further. The psychology of buying the dip is hard when the chart looks ugly, but that is exactly when the asymmetry is in your favor. Let's shift to the future outlook and the risks because we must be objective. The biggest risk to Circle is not Bitcoin price action. It is regulatory overreach or a black swan event in the U.S. Treasury market. If the U.S. government were to default, or if there was a massive liquidity crisis in the Treasury market, the assets backing USDC could theoretically freeze. However, if U.S. Treasuries freeze, your Fidelity IRAs, your SoFi robo-advisor account, and your Schwab Intelligent Portfolios are all in trouble anyway. Circle is effectively holding the same risk-free assets that back the entire global financial system. The de-pegging risk that terrified investors in 2023 is largely mitigated now by the Fidelity Managed Reserve Fund and the direct access to the Fed's reverse repo facility, which Circle has been lobbying for and effectively utilizing through its banking partners. Another angle often overlooked is the programmable money thesis. We're moving toward a world where money is not just a store of value but a line of code. Tesla stock investors often talk about autonomous driving. Circle investors should be talking about autonomous payments. Imagine a world where your electric vehicle automatically pays for its own charging using a USDC wallet, or where your Fidelity mobile app automatically streams micropayments to content creators you watch. This is the economic OS Jeremy Aller talks about. It is not science fiction, it is the API layer being built right now on top of USDC. The bearish sentiment on interactive brokers forums often cites competition from central bank digital currencies. They argue, why do we need Circle if the Fed launches a digital dollar? The reality is that the Fed moves at the speed of government. A US CBDC is likely years, if not a decade, away from being a consumer-facing product. In the meantime, the private sector, specifically Circle, has already won the standard war. By the time a digital dollar arrives,